Welcome to Behind the Billions, where we analyze the forces shaping money, power, and the future of the world. Markets move on fear, confidence, and capital. Right now, all three are colliding. A storm is brewing in the global financial system. The stock market in 2026, will it be a catastrophic crash or the greatest opportunity of a generation? The truth is, it might just be both. Uncertainty is at an all-time high. Inflation, once thought to be under control, continues to linger. Central banks are caught in a difficult position, forced to keep interest rates higher for longer, which puts a major strain on economic growth. At the same time, geopolitical tensions are simmering across the globe, creating unpredictable supply chain disruptions and energy price shocks. On top of all this, the rapid rise of artificial intelligence is both a massive opportunity and a source of unprecedented disruption. Whole industries are being reshaped overnight. This combination of factors has pushed markets into one of the most volatile and uncertain periods we've seen in decades. Investors are nervous, and for good reason. Every news headline seems to bring another reason to sell, another reason to fear. But is that the whole story? Not even close. To understand where we might be going, we first have to understand where we've been. Markets move in cycles. This isn't just a saying. It's a historical fact. Think about the dot-com bubble in 2000. It felt like the end of the world for tech stocks. Valuations were insane. Companies with no profits were worth billions, and then it all came crashing down. But from the ashes of that crash rose the giants of today. Amazon, Google, and others who survived and then thrived. Fast forward to the financial crisis of 2008. The entire global banking system was on the verge of collapse. Panic was everywhere. Yet, that period marked the beginning of one of the longest bull markets in history. From the Great Depression to the pandemic crash of 2020, every single major downturn in history was eventually followed by a powerful recovery. The real question isn't if the market will change, it always does. The real question is, who is positioned correctly when it does? History teaches us that the greatest wealth is often created not when markets are calm and predictable, but during periods of maximum fear and uncertainty. So, while headlines are screaming about a potential crash, what is the so-called smart money actually doing? Large institutions, hedge funds, and billionaire investors, they don't operate based on headlines. They move quietly and they move strategically. While retail investors are often caught up in the daily noise, smart money is focused on the bigger picture. Right now, they are not panic selling. Instead, they are rebalancing their portfolios. This means trimming positions in sectors that have become overvalued and rotating that capital into areas that are undervalued or offer better risk-reward profiles. They are actively hedging their risk using complex financial instruments to protect their downside in case of a major market downturn. Most importantly, they are positioning themselves early for the next cycle. They are looking beyond the current fear and identifying the long-term trends and sectors that will lead the next wave of growth. They understand that fortune favors the prepared, not the panicked. In every market shift, there are clear winners and losers. Capital doesn't just disappear. It flows from one area to another. So where is it flowing now? Let's look at the sectors that are struggling. Areas that are highly sensitive to interest rates, like certain parts of the real estate market and companies that rely heavily on debt to grow, are facing major headwinds. Similarly, consumer discretionary stocks companies, selling non-essential goods like luxury cars and high-end fashion, are under pressure as household budgets get tighter. But on the other side of the coin, there are sectors that are thriving. The infrastructure needed to power the AI revolution is a huge one. We're talking about data centers, semiconductor manufacturers, and advanced networking companies. Capital is pouring into this space. Energy, especially with ongoing global instability, remains a critical sector. And then there are the defensive plays companies that provide essential goods and services like healthcare and consumer staples. People still need to buy groceries and medicine, regardless of what the stock market is doing. The key takeaway is that a falling tide doesn't lower all boats equally. You have to know where the safe harbors are. So why do most individual investors lose money over time, even when the overall market goes up? The answer is simple: emotion. Emotion destroys returns. The two biggest enemies of the average investor are fear and greed. When the market is crashing, fear takes over. People see their portfolio values dropping and they panic sell at the absolute bottom, locking in their losses. Then, when the market starts to recover and headlines turn positive, the fear of missing out, or FOMO, kicks in. They see others making money and they jump back into the market, often buying at the very peak, right before the next correction. This cycle of buying high and selling low is the single biggest destroyer of wealth for retail investors. They're not losing money because they pick bad companies. They're losing money because of bad decisions driven by emotion. The stock market is a device for transferring money from the impatient to the patient. So what does all of this mean for normal people, for those of us who aren't hedge fund managers or financial gurus? It means you have to prioritize strategy over panic. The goal isn't to time the market perfectly. No one can do that consistently. The goal is to build a resilient strategy that allows you to survive the inevitable volatility and stay positioned for long-term growth. For most people, this means embracing the power of diversification and consistency. Investing regularly in low-cost broad market index funds over a long period has historically been one of the most effective ways to build wealth. It removes emotion from the equation. It means you aren't trying to pick the one winning stock. You're betting on the long-term growth of the entire economy. It's not about getting rich quick. It's about not becoming poor in a panic. Understand your own risk tolerance, have a plan, and stick to it. The future may be uncertain, but your strategy doesn't have to be. The global financial system is at a critical juncture. The forces of inflation, technology, and geopolitics are creating both incredible risks and unprecedented opportunities. The coming years will not be for the faint of heart, but for those who can look past the noise and focus on the fundamental shifts taking place, the rewards could be immense. If you want serious analysis that goes beyond the headlines, subscribe to Behind the Billions. This is where the world's biggest financial shifts are explained. Thanks for watching.